Welcome to Talk Tickers. We're your deep dive cutting through the noise of the latest earnings calls. Today we're tackling TSMC's Q2 results. It's a fascinating picture. This semiconductor giant isn't just navigating, it's really dominating a pretty complex global scene.
Yeah.
We'll dig into how they're cementing their role in AI, building the future of computing, chip by chip, from the numbers to the tech. So let's jump right in. The headline numbers for Q2 2025 look pretty strong, right? They beat their own guidance.
They did, yeah. More than just strong, I'd say it really shows just how critical they are. Revenue shot up, impressive figure, 17.8% sequentially in US dollars.
Wow.
Hit $30.1 billion. And that wasn't just like random growth. It was really powered by that demand for the top tier stuff.
The 3 nanometer and 5 nanometer.
Exactly. That's the foundation for so much advanced tech now. And they did that even with some unfavorable FX rates acting as a headwind. And if you look at the bottom line, earnings per share were notable. Surged 60.7% year over year.
60%, that's huge.
Yeah, 15.36 NT dollars. And their return on equity, a really healthy 34.8%. It's a solid performance, sets a very confident tone, not just for TSMC, but really for the whole advanced chip manufacturing space. Tells you they're executing flawlessly.
Okay, let's unpack that Q2 performance a bit more then. We know advanced tech is their game, but just how much did it dominate this quarter?
It's pretty wild, actually. Advanced technologies, and they count that as 7 nanometer and below, just flex their muscles, accounted for a massive 74% of their wafer revenue.
74%.
Yeah. And within that, the real cutting edge, 3 nanometer, that brought in 24%. 5 nanometer was 36%, and 7 nanometer was 14%. So you see 3 and 5 nanometer together. That's 60% of their business now. It shows that unparalleled lead pushing out older tech. That's where the high margins are.
Okay, and where's all that demand coming from? Who's actually buying all these really advanced chips?
Well, the big story is high-performance computing, HPC. That was the undisputed powerhouse.
Right.
It grew 14% quarter over quarter, made up 60% of total revenue.
60% just from HPC.
Yeah, 60. That's where you really see that, insatiable AI chip demand playing out. Smartphones were healthy, too, up 7% to 27% of revenue. And IoT, up 14%. DCE, digital consumer electronics, surged 30%, so broad strength. Automotive, though, that stayed flat.
Okay, so impressive top line, clear demand drivers, especially HPC and AI. How did that flow through to their operations, margins, efficiency?
Well, the gross margin, it did dip slightly, sequentially down 2 percentage points to 58.6%.
Okay.
That was primarily that FX headwind we mentioned, and also, a bit of expected dilution from their overseas fabs starting to ramp up. But higher capacity utilization and cost improvements, they really helped offset that.
Right.
And actually, operating margin increased, went up 1.1 percentage points to 49.6%.
So good operating leverage then.
Exactly. A clear sign of strong operating leverage as the volumes went up.
And on the balance sheet, anything stand out there showing their financial health?
Oh, yeah. They ended Q2 with a huge pile of cash and marketable securities, $90 billion US dollars, just an enormous war chest.
90 billion.
And what's really telling about their efficiency is how fast they collect payments. Accounts receivable turnover days, that dropped by 5 days. It's down to just 23 days.
23 days, that's incredibly fast. Shows their leverage, right?
Huge customer leverage. They get paid almost immediately. And inventory days dropped too by 7 days to 76. Those high demand N3 and N5 chips, they're flying off the shelves.
Makes sense.
In CapEx, they spent $9.6 billion US in Q2, putting that cash back to work for future capacity.
Okay, that strong Q2 definitely sets the stage. So looking ahead, what do they guide for Q3? Are they expecting this momentum to just keep rolling?
They certainly are, yeah. TSMC expects Q3 revenue between $31.8 billion and $33 billion US.
Good.
At the midpoint, that's another 8% sequential jump and a really strong 38% year-over-year increase. So growth is actually accelerating.
38% year over year. Wow.
Yeah. Gross margin, they project that between 55.5% and 57.5%. Operating margin 45.5% to 47.5%. And interestingly, they kept their full year 2025 capital budget the same, still in that $38 billion to $42 billion US range. We can circle back to why that might be.
Yeah, let's. But first, you keep mentioning that foreign exchange headwind. It sounds like a pretty big deal for them. Can you break down just how much these currency swings impact their profit?
It's a major factor, a constant balancing act. See, almost all their revenue is in US dollars, right?
Right.
But about 75% of their cost of goods sold, that's in new Taiwan dollars, NT dollars. So when the NT dollar gets stronger against the US dollar, it directly eats into their reported profit. They actually share a metric on this. Every 1% appreciation of the NT dollar versus the US dollar, it cuts reported NT revenue by 1% and crucially gross margin by about 40 basis points.
40 basis points for every 1% move. That adds up fast.
It really does. In Q2, that NT dollar strength hit their gross margin by 180 basis points. And for Q3, they expect an even bigger impact, 260 basis points.
Wow.
So yeah, a stronger Taiwanese dollar, it basically acts like a direct tax on their profitability, even when the underlying business is absolutely booming.
Okay, that's a substantial hit. So how do they actually manage that? Those currency pressures, plus the costs of ramping up the overseas fabs, which also dilute margins early on, are they just stuck?
No, not at all. They're very clear about this. They do see margin dilution from the overseas fabs, maybe 2-3% annually at first, maybe widening to 3-4% later over the next 5 years. But TSMC always emphasizes they have like 6 levers for profitability. FX is just one of them.
Okay, what are the others?
Things like leveraging their scale, especially as Arizona grows, improving cost structures, working tightly with customers and suppliers, and critically, technology leadership and pricing power. They sound very confident about their long-term gross margin target, 53% and higher. They can lean on those other 5 factors to manage through the FX pressure. It's a clear strategy, not just hope.
That makes sense. That huge investment plan, their confidence, it must tie into how they see demand evolving, especially for AI. Let's dig into those demand trends. What's the picture for 2025 and beyond?
Yeah, the Q2 strength, as we said, was largely driven by that really robust AI and HPC demand, and they expect that trend to continue even aggressively into Q3. For the full year 2025, they actually upgraded their revenue forecast, now looking at around a 30% increase in US dollar terms.
30% for a full year. That's a big upgrade.
It is. It's significant acceleration.
Yeah.
And it's fueled by, relentless demand for 3 nanometer and 5 nanometer, especially from HPC. Really underlines their central role right now.
Is it all sunshine and AI roses, though? Are there any clouds, any segments where demand looks a bit weaker?
They're definitely aware of broader uncertainties, things like potential tariff policies. Those could hit consumer markets, the more price-sensitive segments.
Right.
They did note some short-term upside from rebate programs in China, but overall, they think the non-AI market will only see a mild recovery in 2025.
So a bit of a two-speed market then.
Very much so, yeah. A clear split between AI-driven demand and everything else.
But that AI demand, it really does feel structural, right? Not just a cycle. How are they thinking about that explosion people talk about?
Absolutely structural. They pointed to the explosive growth in AI token volume, basically, how much AI models are being used. That shows increasing adoption, driving this profound need for more compute power, more leading-edge silicon.
Makes sense.
So they see AI demand staying incredibly strong. That includes rising demand from sovereign AI initiatives, too, governments building their own AI.
Interesting.
And they also anticipate an explosion in on-device AI. Think AI on your phone, in your car. They said that's coming in the next 6 months to a year. And noted the chip sizes, the die sizes for those edge devices are getting significantly bigger.
So it's not just data centers. AI is coming everywhere.
Exactly. Coming to the devices in your pocket, in your home, needs lots of silicon.
Now, TSMC's global footprint, that's been a huge topic, geopolitically and for the industry. What's the latest on their big expansion plans outside Taiwan?
Yeah, it's a massive strategic shift. Their overseas decisions are really driven by 3 things: customer needs, wanting geographic flexibility, and crucially, getting the necessary government support. In the US, Arizona, they're planning that truly massive $165 billion investment.
$165 billion. It's just hard to wrap your head around that number.
It really is. And it's not just a couple of fabs. They're aiming for a gigafab cluster. That means 6 advanced wafer fabs, 2 advanced packaging fabs, and a major R&D center. It's an entire ecosystem.
Wow, a gigafab cluster. So what's the actual progress on the ground in Arizona? Are they hitting targets? Any hiccups?
Progress seems remarkable, actually. Their first Arizona fab, the N4 one, it hit high-volume production back in Q4 2024. And importantly, yields were comparable to Taiwan. That's a huge win.
Getting yields right overseas is critical.
Absolutely. And the second fab for 3 nanometer, that building is already complete. And what's really interesting is they're speeding up its production schedule.
Speeding it up. By how much?
By several quarters, because U.S. customer interest is just so strong, they want those chips sooner. And construction on the third fab, that's for 2 nanometer and the future A16 tech, that's already started. And again, plans to accelerate production there too, driven by AI demand.
So a lot of pull from customers.
Huge pull. Once it's all done, roughly 30% of their 2 nanometer and more advanced capacity will actually be in Arizona, a significant shift.
Okay, beyond the massive U.S. investment, what about Japan and Europe? Are those moving forward too?
Yeah, very much so. In Japan, their first fab there, a specialty tech one in Kumamoto, started volume production late 2024. Again, with very good yields. That's key.
Right.
And a second fab in Japan is scheduled to start construction later this year. In Germany, the plans for a specialty fab in Dresden, they said that's progressing smoothly. Strong government commitment there too.
Yeah.
It's a truly global diversification effort.
And back home, Taiwan obviously remains their core. Are they still investing heavily there, or is the focus really shifting overseas now?
Oh, no. Taiwan is absolutely central. Still the mothership. They continue to invest heavily there, planning 11 wafer fabs and packaging facilities over several years.
11 more facilities in Taiwan.
Yeah, including multiple phases for the new 2 nanometer fabs in Hsinchu and Kaohsiung science parks. That's to meet what they call robust structural demand. So huge investments both at home and abroad.
Okay, speaking of 2 nanometer, let's talk cutting edge. The next gen nodes, N2, A16, A14. This is where the real tech race is, right? What's the status?
It absolutely is the race, and TSMC is aiming to lead it. Their N2 and A16 technologies, they're positioning those as the leaders for energy-efficient computing. That's paramount for AI.
Right. Power consumption is a huge issue.
Exactly. N2 is on track for volume production second half of 2025. The ramp profile looks similar to N3, and they expect more new designs, more tape-outs for N2 than they saw for N3 or N5 in the first couple of years.
More designs than N3 and N5. That's strong confidence from customers.
Huge confidence, driven by both smartphone and HPC demand.
And A16. That sounds really interesting, especially that superpower rail tech you mentioned. What does that actually do for performance or power?
It's pretty groundbreaking conceptually.
Yeah.
A16 with superpower rail, it's basically a redesign of how power gets delivered across the chip itself.
Okay.
Think of it like building dedicated power lines directly underneath the transistors on the backside of the wafer. It allows for much more direct and efficient power delivery.
Ah, I see. So less resistance, less power loss.
Exactly. Leads to incredible efficiency gains. They're quoting an 8-10% speed boost or maybe 15-20% less power at the same speed compared to the N2P node, plus better chip density.
And that's perfect for AI and HPC.
Precisely what AI needs. Those complex signal routes, dense power delivery. A16 volume production is on track for the second half of 2026.
And then even further out, A14. Feels like they're constantly looking 2-3 generations ahead.
They absolutely are. A14 uses their second-gen nanosheet transistor structure, promises another full node improvement over N2.
Nanosheets, okay. Better control over the transistor channel.
That's the idea. Superior gate control, less leakage, higher performance, or lower power. A14 is aiming for another 10-15% speed jump, or maybe 20-30% power reduction compared to N2, plus about 20% more density.
And when is that slated for?
Development's on track, volume production scheduled for 2028, and they're planning a superpower rail version of A14 for 2029. These advances are just critical for them to keep capturing future growth, cementing that leadership.
Okay, let's connect all these incredible tech details back to the investor perspective. Capacity tightness on these advanced nodes, that seems to be the recurring theme. Huge implications. Right?
Absolutely top of mind for everyone. TSMC confirmed it point blank. N3 capacity will stay very tight for the next couple of years.
Couple of years.
Yeah. And N5 is also very tight, largely because AI products are shifting over from 4 nanometer. So it's not just a temporary blip, it's fundamental demand hitting limited supply. They did mention their gigafab cluster approach helps manage this a bit. Having 85-90% common tools across N7 and 5 and 3 and N2 makes it easier to, adjust or convert capacity between nodes if needed.
Flexibility is key.
Definitely. But the bottom line, they explicitly said all their leading edge tech, N7 and below, is very tight. And they're working flat out to narrow the gap between that huge demand and what they can supply. And you know what that means.
Pricing power.
Exactly. Translates directly into pricing power.
So given that extreme demand and the fact they just raised their full year revenue guidance, why didn't they raise the CapEx guidance too? Some might see that as maybe a sign of caution.
It's a fair question. and they addressed it. While revenue guidance went up, they're holding CapEx steady for now. It's a mix of factors. One is those macro uncertainties. They mentioned things outside their control. And the other is just, physical constraints. How fast can you actually build and ramp up these incredibly complex new fabs? There's a limit.
Right. You can't just snap your fingers.
Exactly. They clarified that CapEx you spend in 1 year is really for future business, not necessarily immediate revenue. They said they won't hesitate to invest when opportunities are clear. And they kind of implied CapEx is unlikely to drop significantly anytime soon, suggesting it probably trends higher in future years as these plans solidify. It felt more like disciplined spending than caution.
Okay, discipline. And despite all these pressures, the FX, the overseas ramp, costs, how confident did they sound about hitting that crucial 53% and higher gross margin target long term? What are the biggest risks there?
They sounded incredibly confident, emphasized their ability to earn their value. That means using pricing power, especially when capacity is this tight.
Leaning on that tightness.
For sure. Pricing is one of their strongest levers, right alongside tech leadership and cost reduction efforts. The biggest risks, still those external macro things, currency swings, geopolitics. But they really believe their strategy and the demand profile lets them navigate that to hit the target.
Okay, shifting gears slightly. Beyond the core chip market, what about potentially massive new opportunities? Like, say, humanoid robots. Did management give any hints there?
They did, and this is where you get a glimpse into the really long-term potential. Management said, look, it's too early to put numbers on humanoid robots for 2025 or 2026.
Okay, fair enough.
But they highlighted the immense complexity. Initial uses might be specialized, like in medical fields. But what really stood out, the massive sensor requirements and the need for significant compute power.
More compute needed.
A lot more. One customer apparently even suggested the robot market could eventually be 10 times the size of the EV market.
10 times EVs. Wow, that's speculative, but huge if true.
Highly speculative, yeah. But it's an early hint of a potentially enormous, completely new wave of demand down the road that would require unprecedented amounts of both leading edge and maybe specialty chips. It just further solidifies TSMC's future role. Definitely a space to watch.
Absolutely. Okay, one final point. With all this talk about tight capacity potentially leading to price adjustments in 2026, did they see customers trying to pull orders forward into 2025 to lock in current prices?
No, interestingly, they confirmed they saw no signs of customers trying to pull demand into the second half of 2025.
Why not, if prices might go up?
Largely because the cycle times are just too long on these advanced nodes.
Yeah.
Like for 3 nanometer, it can take around 4 months from placing the order to getting the finished wafer.
4 months lead time.
Yeah. So there's just very little wiggle room to suddenly pull things forward, even if you wanted to. It speaks to the structured nature of the advanced node supply chain.
Got it. Okay, that makes sense. Let's move to our next segment. All right. Welcome to our not financial advice segment. This is where we pitch an outrageous, maybe, but plausible trade idea based on everything we just heard. Strictly for entertainment, food for thought. What's the play this time?
Okay, so looking at TSMC's dominance at the leading edge and how the market seems to be splitting, here's an idea. Consider a pair trade.
Okay, a pair trade. Long, short.
Exactly. Short selected legacy semiconductor foundries, or maybe companies that are heavily reliant on those older generation chip designs, the ones where overcapacity seems likely to stick around.
Right, the commoditized end of the market.
And the long side.
Go long TSMC itself. Or perhaps an AI-focused chip designer that you know is a major partner for TSMC's cutting-edge stuff N2, A16.
Okay, what's the core thesis behind that pair? It's pretty straightforward based on their call. TSMC explicitly flagged extreme tightness in N3, N5, and N2 capacity. They talked about their ability to convert capacity between these nodes. And critically, AI demand is just relentlessly pushing towards the most advanced, most power-efficient nodes like A16. The sheer cost, the capital intensity to build these leading nodes means only a few players, mainly TSMC, can do it.
Solidifies their moat.
Exactly. Solidifies their moat, gives them pricing power. Meanwhile, those older nodes, they face commoditization, oversupply risks. So the trade leverages that growing split, that divergence between the leading edge winners and the mature node laggards.
Interesting play. Leverages that two-speed semiconductor world we talked about.
Precisely.
And that wraps up our Talk Takers deep dive into TSMC's Q2 2025 earnings. You've really heard how TSMC isn't just growing, it's fundamentally shaping the future of technology.
Yeah, we've seen a company that's just firing on all cylinders in its key advanced tech segments, driven by that almost unbelievable AI and HPC demand. all while they're strategically building out globally and pushing chip tech to the absolute limit. They really are indispensable right now.
And their ability to manage those tough macro headwinds, FX, overseas fab costs, while sticking to those strong long-term margin targets. It just underscores their leadership, their operational skill. It's a complex dance.
Yeah.
They seem to be leading it very well.
For sure. TSMC remains that critical enabler for the whole global semiconductor industry. And those investments in N2, A16, A14, they're clearly positioning themselves to capture growth for years, probably decades to come. They're not just building chips, they're building like the basic infrastructure of our digital future.
Well said. As always, please remember this discussion is purely for informational purposes. It is absolutely not financial advice. We always encourage you to do your own research, talk to a financial professional before making any investment decisions. But think about it. How have TSMC's strategic choices today ripple through the entire tech world and maybe even beyond for decades? It's fascinating stuff. Thank you for joining us for this deep dive. We hope you gained some valuable insights. We'll be back soon with another earnings call breakdown. Until next time, stay informed.